Well, global uncertainty continues. There's been a lot of guesses on Canadian banks as well. How could U.S. trade uncertainty shape and affect the outlook for the big six for 2026? Let's ask Carl de Souza, SVP at, Morningstar DBRS. I got a frog in my throat there. Carl, thank you very much for joining us. I'll see if I can talk now.
Thanks for having me, Roger.
How are the banks looking right now as they at the start of 2026? They came off a good year. Are we expecting a repeat?
Yeah, so Roger, they did come off a very solid year, supported by their capital markets and wealth management businesses and fee income, which helped bolster revenues and net income. Heading into 2026, our Canadian banking sector outlook is unfavorable. And just to clarify, this refers to the operating environment where we expect tariff-related macroeconomic and geopolitical uncertainty to linger. So the environment heading in, as we're in 2026, the baseline macroeconomic outlook has generally improved, and stimulative fiscal and monetary policy should also support growth. But looming risks add key elements of uncertainty that could negatively affect GDP growth, unemployment, and inflation, all important things that drive bank performance. So we do believe that pressures from sectoral tariffs will likely result in further credit deterioration for the big six banks in fiscal 26 before provisions for credit losses, or PCLs, potentially peak in the second half of the fiscal year. And then we also note that the Canadian and U.S. economies could experience adverse effects if upcoming negotiations on the CUSMA trade agreement prove problematic and or the U.S. decides to exit the agreement. So having said all that, to answer your question, nonetheless, we expect lower but still solid year-over-year earnings in the fiscal year, reflecting higher credit costs, slower net interest income growth, and lower capital markets-related revenues following a record year last year.
I mean, that says a lot about the banks that you're talking about. You factored in the possibility that CUSMA may fall apart, and yet you still think they'll have they have the possibility of a good year.
Yes, and there's several reasons for that. So the interest rate cuts in 2025 should continue to provide some relief for borrowers with respect to debt servicing costs as maturities continue to reprice. Why we do expect that deterioration is that there will likely be a pause on further rate cuts, and there's a widening income gap. And those sectoral tariffs that I mentioned will continue to pressure pockets of borrowers. However, the big six banks maintain very diversified business models that have proved resilient and provide earnings resilience in the face of an uncertain and potentially volatile operating environment. As I mentioned, fee-based income by geography and product should enable the big six to bolster overall earnings and mitigate any lending income pressures from slower loan growth and broadly stable to slightly improving net interest margins. So that diversification and also that exposure that several of these big six banks have to the U.S., which is a more resilient economy, in a much bigger market that drives those capital markets and wealth management revenues, will continue to help boost, revenues and maintain that earnings resilience.
And what the other one along with trade that you mentioned was geopolitical concerns. What are some of the possible headwinds that you're looking at and factoring in?
Yeah, so we've seen, there's lots of things going on right now. The Venezuela situation, and the ongoing conflicts with Ukraine and Russia, and some of the other conflicts as well with in the Gaza. So we're seeing how all these continue to develop and evolve, and how those might have more global implications on growth, as well as obviously the trade impacts that I mentioned earlier as well. So the combination of those things skew risks to the downside in 2026, but we remain optimistic that cooler heads will prevail. The trade situation and CUSMA will hopefully be resolved, in an orderly manner. That will enable the operating environment to not experience some of that harder downside risk. And then I think the big six banks as well are also focused on cost discipline and several undertaking restructuring programs. So that will help them to manage non-expense growth, which will be key to delivering positive operating leverage.
Did you look at AI at all and the impact on the banks and incorporating it?
We did look at AI. All the banks are talking about AI, Roger. I mean, there's two banks that have actually quantified AI, being TD and RBC. And, they're projecting revenue uplift and cost savings. And all the banks are deploying AI in various forms. But I think there's still, time to develop here to see tangible results. And they will continue to maintain those expenses toward AI as it's an important part of future productivity and efficiency, as well as I said, potential revenue uplift. So, all the big six banks have big budgets that they can deploy here, but as I mentioned earlier, RBC and TD have quantified some potential gains from AI, but those are looking a few years out, some of those targets. But in coming years, including fiscal 26, we expect more progress on that front.
And what are they saying? Like, what kind of savings are they projecting?
So TD I think they projected potential $500 million in revenue uplift, $500 million in cost savings, and in the medium term, although they didn't necessarily qualify exactly when that would be. Their medium term in their recent investor day was 2029, but they did not specifically quantify that 2029 year for those AI gains that I mentioned. And RBC has, I believe, 2027 for up to $1 billion in AI enterprise value, although they did not carve out or separate that into what would be revenue uplift versus cost efficiencies.
Okay, we'll leave it there, but Carl, thank you as always for joining us.
Thanks very much, Roger. Appreciate it.
Carl Souza is SVP at Morningstar DBRS.